Chuck Carver on the Chuck in the Markets Up, Chuck. And in today's video, VidX blog was actually titled "Prices Can Lie," and the real point of that is, as I said in the blog, written part of the blog, Warren Buffett once lamented that he doesn't understand why people take their cues from prices rather than values, and that's really what this post and what this week has been all about. So, what I'm going to start with a company here called Natural Gas Services, which is an interesting little small cap company. But the reason I chose this was because if you notice, if you look at just the company from the perspective of stock price, and this is only a chart that only spans about 7 or 8 years. The company actually went public in October of 2002. You'll see this period where you had this huge spike up in stock price and a huge drop in stock price, and a huge rise and a huge drop and a huge rise. So obviously, when this was going on, people felt probably very good about the stock, and then when this was going on, people didn't feel so good about the stock. Then they felt good about it again, then not so good, and then good about it again, depending on, of course, where they bought it. But the point is, as you can see by this picture, I believe that the stock prices can be very, very disturbing. They're very erratic, they're very volatile, and they really don't make a whole lot of sense. Now, if I look at the same company just from the perspective of its earnings per share and its growth rate of earnings per share, I want you to notice you have a totally different picture. You can see that earnings growth has been very consistent. Now, they did obviously, as you're going to see, as you'll see with many companies, they did get hit in a recession, but they still had a pretty good year even in the recession. So, the reality of it is when I look at this picture of the company, I get a different perspective. I see a company that's been growing, that's been a growing business over the last 9 years, and even notwithstanding this one drop in earnings, they still have a very strong growth rate of over 27%. So when I look at Natural Gas Services from the perspective of its earnings justified value, which is what I believe this line really shows you, and I'll make that point in a moment, you have a totally different perspective than just by looking at price. Now, when you combine the two, this is where you really get, I think, a very clear perspective. As you can see that for the first couple of years here, the price tracked earnings, there was still some volatility here. I want you to notice the volatility here was actually quite strong. But then we had this period, for whatever the reasons were, and I really don't know because I don't particularly follow this company, but you can see that the price went dramatically up, from single-digit numbers, $9 a share up to $40 a share. And there was a strong earnings year. I want you to notice earnings growth was very strong that year, so people got pretty excited about that. But then, of course, they were disappointed in the following year, or somewhere actually in the middle of this year, and the stock price fell precipitously from the high 30s back down into the mid-teens. Actually, the low got down to 11. But again, the point is the stock price was lying here because it was not reflecting the true value. Then we had a period where we had good earnings growth again. The stock price was undervalued. I want you to notice that the price immediately went, not immediately, but over the year and a half went back to value. Then, of course, the recession came and the stock price fell, and now we're seeing, in essence, the mirror image of what we saw here, in my opinion. You're seeing the stock price come back to, this chart would indicate value of around $25 a share, and the stock's trading at 18. So the moral of the story is that stock prices can lie, but true value is what really matters. So as investors, what I've always tried to encourage people to do is determine the value of the business based on its cash flow and earnings. One point that I want to make on that is, there's actually a mathematical reality to that. These companies, these numbers aren't just arbitrary. They're based on mathematical returns that are generated based on the amount of cash flow, and that's what really you're looking at here with this green area. It's the amount of earnings, or cash flows that the company is actually generating, and that in the long run becomes much more important than the volatile stock price. This is Chuck Harville saying thanks for listening. I'll talk to you again tomorrow.